Hi Sunil, this is Riddhi. I wanted to do this spreadsheet for you so you can see what I was suggesting to you in the morning. So here is what we had discussed. I'm comparing three loans here. I know this doesn't have the 30 year. I'll come back and do another one for 30 year. But this is what 15 year, your current mortgage compared to a new 15 year, a 7/1 arm and a 10/1 arm. So this is the one, the current one. It shows the loan amount is 295. Keep in mind I am treating it as a mortgage that was existing, started in June of 2008. You started at 340,000. Now the balance is about 295,000, and the rate that we have, and I took it from your Citibank statement, is 5.375. Your payment, and it's amortized over 180 months. Your payment is 2,756. So this does not take into account your taxes or insurance or anything like that, because no matter what program you have, you will still have those. So I'm just comparing your principal and interest payment. It comes to 2,756. I also made an assumption that you are at least in a 25% tax bracket. You might be probably in a higher tax bracket, but I'm looking at the worst case scenario, so at least 25% tax bracket. So since you're paying $2,756 every month in principal and interest, your tax benefit is $330. So your actual cost of owning the house after the tax benefit for just principal and interest part is $2,425. Now let's compare this to the new 15 year, which is we are going to get a new 15-year mortgage. The loan amount, the maximum loan amount that we can get is 285,000. We can get 4% interest rate. Will start 180 months amortization, a new one, and your payment goes down to 2,108. It is a combination of two things. Your loan amount has gone down because you have paid off money, and also because we are reducing the loan amount by $10,000. So since you're reducing the loan amount, your tax benefit also goes down. You only have a tax benefit of 238 now, because you're borrowing it at a lower rate, and your tax payment after the tax, your payment comes to 1875. So the difference between these two payments is $555. Now let's compare this to a 7/1 arm. Again, the loan amount is 285, 4.25 interest rate, 360 months amortization. Payment drops down significantly to $1,402, and just because their payment is lower, we are borrowing at a lower rate, our tax benefit also drops down to $252. So our payment after the tax benefit comes to $1,276. Now the last option on this one is 10/1 arm. We are at 285, 4.5 rate, 360 amortization, 1,444. Payment goes up a little bit because the rate is higher, and our tax benefit goes up a little bit. From 252 it goes to 267. So our total payment is 1,248. Now let's look at the total cost analysis. Our total payment, if we were to keep this mortgage, is 165,335 over 5 years. I know you don't want to keep the house for 5 years, but I'm just assuming that if we were to, so you would have paid 165,335, and you would have paid 98,000 out of that towards your principal. You would have paid 66,860 towards your interest, and your balance would be 196,525. Okay. So their total cost would be 66,860. Just keep in mind we're going to reduce the principal paid from that, and you also have the tax benefit of 16,000. So your after tax cost is 50,145. So let's go down to a 15 year. You will have in next 5 years your total payment will be 126,487. Principal paid will be 76,782, a little bit less, because we are starting it new. And interest in there's no mortgage insurance. You would have paid 49,000 in insurance. Not insurance, I'm sorry, interest. Your balance left will be 208. So your total cost will be 49,705, out of which you would have 12,000 your tax benefit, and your tax after tax cost will be 37,279. So you would have saved 12,866. Keep in mind it is taking into account that you have a higher balance. You still come out ahead by $12,866 in the next 5 years if you were to get a new 15 year. Now let's talk about the 7/1 arm. I know you're looking at it, why is my total payment 114,122? Because if I'm saving 1200 some odd dollars, then this amount should be less. But I made some assumptions. Remember, we were talking about that if we were to make a little bit higher payment, would it benefit us? So I took $500, not the entire 1276 that we're saving, but just extra $500 and applied it to your payments. That's why that seems higher. So if we did that every month, then you would have paid off around 60,000 in principal. You would have paid 54,000 in interest, not a lot of difference, and your balance left will be 225, and your total cost will be 54. So this is a little bit more expensive option than the 15-year, but it is giving you better cash flow. And keep in mind, you still have around $776 that you haven't used yet. So if you were to use the 776 that you are saving every month for 60 months, that would also, you should add that too, it doesn't show here, that's another 46,000. So actually you still come out ahead. Now the last option is, in total payment you would have paid 116. Again, it assumes the reduction of $500, meaning we are adding an extra $500 towards the principal. So our payment is 116,643. Principal paid would have been 58,773. Interest paid would have been 57, and balance left will be 226. So our total cost is 57,870, and the tax benefit will be 14,000 because we are paying higher interest, and after tax cost will be 43,403. You still would have saved $4,062. Okay. So now let's go down. It shows you what it is doing in 5 to 10 years. In 5 years, if you had added an extra $500, you would get paid off in 17 years and 83 months, 17.83. And if we were to do a 10-year, you would still pay off in the same amount because we are paying a little bit extra, and we would have saved around 105,000 in interest savings over the term of the loan. So I'll send you a 30-year. In my opinion, you have to decide what is important to you. If you want to do because you want to stay in the house and just save money, then I would say do a 15-year. Otherwise, if you're looking for a cash flow, able to still save money, then a 7-1 or a 10-1 would be a better option. And I'll send you the 30-year.